Good afternoon to everyone. Thank you for joining us today. I'm Dhaval, Kapadia, Director of Investment Management at Morningstar India, and welcome to the panel discussion on finding value across the investment landscape. And of course, this is like a topic that's very pertinent today. Investors today are sort of spoiled for choice, right? And this is not just a normal mystery. As if not done properly, it can lead to a poor outcome if not navigated well, right? And whether it's value or growth stocks, IPOs, debt, gold, crypto, or global investing. I mean, where does one find value in the current scenario? So to share their insights on markets and how investors can position their portfolios, I'm pleased to invite an exceptional panel of stalwarts, which includes Sankaran Naren, Executive Director and Chief Investment Officer at ICICI Prudential Mutual Fund, Nilesh Shah, Managing Director of Kotak Mutual Fund, and Kemp, Global Chief Investment Officer at Morningstar Investment Management. So, welcome to all of you.
Thank you.
Hope you're doing well.
Yes.
Thank you, Dhaval.
So, before we get into a sort of a deep dive onto various issues, a quick sort of so-called defreeze question for each of you, and you can go in any order that you wish. But given all that's happening in the markets, in the economy, and so on and so forth, what is your most, or which is your most favored asset class at the moment? And we can get into details later on, but just a very quick sort of top of mind answer for each of you. Naren, would you like to go first?
Basically, we have been recommending asset allocation as the most favored asset class. And
Okay.
if you're asking me within debt, we've been recommending floating interest as the most favored subset. And then within equity, large cap as the most favored asset class. And these two are what within the asset class, what we like. And I think, we are headed for a period of volatility. When you are headed for a period of volatility where interest rates are going to go up in debt and equity is going to see volatility, we can't think of a better way to play it through than to play it through asset allocation at this point of time. And that is why if you're going to see interest rates go up, nothing other than floating interest can protect you at this point of time, is our view. And large caps are obviously safer than mid caps. Mid caps are safer than small caps is the way we look at it.
Fair enough. Sure. Makes sense. Nilesh bhai, would you like to go next?
So broadly in agreement with Naren, we believe right now this is time to be disciplined in your asset allocation. Equity is equal weight allocation, marginal overweight to large cap, marginal underweight to small and mid cap. In the fixed income, either you go floating as Naren suggested or go dynamic, trusting fund managers to manage interest rate volatility. On gold also we are equal weight. So effectively, this is time to be disciplined rather than adventurous. But correction in market will again give you an opportunity to become overweight equity as equities are now trading at their historical valuations.
Sure. Fair enough. Dan, what about you?
Well, hello, Dhaval, and hello, everyone. It is wonderful to be with you today. And that's an incredibly difficult question, Dhaval. As you know, we look at over 300 different asset classes, sectors, different types of bonds around the world. And so to pick any one would be extremely difficult and probably quite foolish. And so I'm going to agree with my fellow panelists that the importance is to get the right balance of assets as you build your portfolio. And that balance will depend on how long you're thinking about investing and how much risk you're able to take. So if I had to pinpoint a particular equity market that's looking attractive at the moment, then I think Japanese equities are often ignored. That's a market which looks reasonably attractively valued, and we're seeing some important fundamental change there. And then from a fixed income side, again, US Treasury bonds are probably the most boring asset class in the world, and there's certainly things that are disliked by many investors at the moment because of that expectation of inflation, which tends to be bad for bonds. But they typically do a reasonable job of balancing equity markets. They haven't done it this year, but that doesn't mean that they won't do it in the future. So that balance between equities and bonds is all important, as we've said. Asset allocation when you're investing for the long term is the key.
Sure. So the common thread that I gather here is asset allocation, like everyone's saying. And Naren, just on that point, one of the funds that you run out there is the Balanced Advantage Fund, which in a way, manages where you manage the allocation between equity and debt on an active basis, right? And as of April end, I believe the net allocation to sort of equities was at about 36%. I don't know if it's changed during May, and which is like the closest level over the last 3 years that you've been to equity in that multi-asset kind of fund. So given that we've seen markets correct a bit, valuations have also sort of at the margin sort of moderated a bit. What are the key risks that is sort of driving this low exposure to equity at this point of time?
I think the key risk is not, as Nilesh pointed out, equity valuations are at least slowly correcting. But the problem, what is happening at this point of time is that interest rates are steadily going up and showing no signs of stopping. So, if 10-year yields keep on going up, somewhere debt is getting more attractive also. Even in India, in 3-6 months' time, after, let's say, a June rate hike and an August rate hike and possibly an October rate hike, then you will have a situation where interest rates will be so high that is the reason which is also holding up equity increases in the portfolio in some of these products. Mm-hmm. So I think, we are in a situation where increased interest rates is also some of the reasons why equity allocation is held up in asset allocation products, because unlike last year where, debt interest rates were really low at this point of time.
Correct. Okay, fair enough. So effectively you're saying the fact that interest rates are moving up is sort of, in a way, a factor that's keeping your equity allocation at the lower end.
Exactly.
Okay. And Nilesh, you had a similar view, right? I mean, one is you've been saying, and I was looking at some of your, the market outlooks that you present on a month-on-month basis, and out there you've been talking about rising interest rates, inflation, and a reduction in liquidity. I mean, obviously due to central bank action, sort of having a negative impact on earnings and corporate profitability, right? And eventually on equity prices. So do you think this will play out over the next couple of quarters, or do you think there will be a lasting impact of this so-called trinity of factors as such?
So Dhaval, we are in a really uncertain world. Mm-hmm. And, tomorrow, if there is a power shift in Russia, the whole outlook towards oil price and food inflation can change. On the other end, if there is further escalation in Russia, the inflation problem will become even worse. Mm-hmm. Similarly, if we look at US employment and housing market, Fed probably needs to tighten more than what is priced by the market. On the other hand, if you look at the first quarter GDP number, which came at minus 1.4%, Fed may not tighten as much as priced by the market. In oil price also, day before yesterday, OPEC raised production quota and yet oil price went up because it was below expectations of the market. On the other hand, if Venezuelan and Iranian oil comes into the market, oil prices can cool off, benefiting India significantly. In India also, while inflation is rising because of the commodity prices, there is a reasonably good chance that we will see the peak somewhere around September if oil prices and commodity prices remain at current level. So in this kind of uncertain market, I don't think so it is possible to take a very, very clear view. As events happen, there will be impact. Some events could be positive, some events could be negative, and which is why you really have to begin maintain your asset allocation, buy good companies in portfolio, and stay invested during this uncertain, volatile time.
Sure. And just to extend that a bit further, I mean, earlier you also mentioned that you've been sort of overweight large cap and sort of marginally underweight small and mid caps. That's a call that you're taking at a fund house kind of a level. So obviously over the last few months we've seen some fall in small and mid caps, and they've fallen a little bit more than large caps as such. So has your view changed, or are you still maintaining that kind of outlook
So,
as such?
in a storm, you want to be in a bigger boats rather than smaller boats. So that's where we are overweight large cap, because we don't think storm has passed. We are somewhere in the middle. Hopefully, this is the ending of the storm and not the beginning of a new storm. But who knows?
Sure. Fair enough. So effectively, you're still remaining sort of overweight large caps and underweight small and mid caps. Is
Absolutely.
what your view is? Okay. Fair enough. And then with obviously what we've been talking of, we've seen a correction in obviously not just India but major markets globally as well over the last few months. So are you adding back equity into the multi-asset strategies that you run out there? And which are the top 2 or 3 global markets or sectors that you find attractive? You mentioned them a bit earlier, but you could maybe talk a little bit about them as well.
Yeah, sure, absolutely, Dhaval. So yes, we are adding a little bit more back into risky assets at the moment, and that's because we have seen these significant price falls. But I think as we look at the prospect of markets, we know that over the short term, the outlook is very uncertain. We don't know what the political situation is going to be. We don't know really what the inflation and economic situation is going to be. And so short-term investing isn't really investing. It's just trading. And there's nothing wrong with that. It's just different from what we're all focused on, which is that long-term progress towards people's financial goals. And if we look out over the next 20 to 30 years, most people's investment horizon, if you're starting investing, or if you're quite young, then the key drivers are going to be the growth in the earnings of the businesses in which you invest, and then also the amount of payout that you receive as an investor, whether that's in dividends or buybacks, that sort of thing. As we move shorter term, so let's say over the next 5 to 10 years, then the key determinant of returns is going to be valuation. So changes in valuation, changes in the enthusiasm of other investors for the assets that you hold. That's really going to drive the bulk of your returns. And so that's why it's so important to think about the valuation of your assets when you're investing over that sort of time period. And the reason I preface it like that is that although we've had really sharp falls in the US markets, and particularly the technology stocks within that, we have to remember that these stocks started at very high valuations. There was a lot of optimism baked into the prices of these stocks. So although they've fallen a long way, so far they don't look to us to offer really good value. They're not as overpriced as they were before, but we certainly wouldn't see them as being underpriced. Equally, other markets in the world have done less poorly over the year to date and have held their valuations much better. And so they were a little bit cheaper than they were, and they're more attractive than they were. But they haven't gone through that big price decline that's making them very attractive. So what we're seeing at the moment is a pretty narrow spread of valuations across asset classes. And that's a time for investors to think about the overall robustness of their portfolios and not take any really strong views, in our opinion. Because if you take very bold investments when you have a narrow spread of valuations, then there's a lower likelihood that you're going to be right. So as we've already talked about, having a portfolio that can deal with a range of short-term outcomes, whether that's the war in Ukraine, whether that's what's happening with energy prices and food prices, rising interest rates, all these sort of things, having a portfolio that's not really focused on one particular area of the market is probably the best that people can do. Having said that, of course, as prices fall, then what you'll find is if you don't make any changes to your portfolio, then it gets out of balance. It changes from where you want it to be. And so that's why the first thing that investors should think about is rebalancing their portfolios back to their ideal weight. So we've been doing some of that. Also, we've been adding a little bit to equities in general and high yield bonds as well. That's an area that's become unloved pretty quickly, having been very popular among investors. So we're seeing some less creditworthy companies, typically in Europe and the US. They're offering value. I already mentioned Japan is offering a little bit of value, but there's not an enormous amount of value out there at the moment in our view, and so important to get the overall shape of your portfolio right.
No, fair enough. So effectively what you're saying is rebalancing, but in a gradual way and not taking sort of an oversized bet on any particular sector or any particular sort of country at this point of time. Sure.
Exactly right, Dhaval. Sorry, just to finish that off,
yes,
a helpful picture that people might have in their minds is that the market we're in really suits test match cricket as opposed to 2020. That this is a time that you want your opening batsman, your portfolio to just stay at the crease and score slowly. Whereas in 2020, of course, you want to score quickly. There's plenty of opportunities for boundaries, but we're not in that market at the moment. It's a time to just to stand at your wicket and stay there as long as possible.
I think that's a pretty useful analogy, definitely. Naren, talking a little bit about sectoral sort of views as such. I mean, I was just looking at how the value discovery fund which you manage is sort of positioned in terms of its sectoral kind of allocations as such, and I saw that the exposure to cyclical sectors, which includes financials, energy, basic materials, and so on, stands at around 50% or so, and which is like close to its highest level over the last 3 years. So what's your view on cyclicals at this point of time? Do you think there's still steam left in some of these, value-driven or cyclical kind of, sectors as such?
See, clearly, if you look at financials, that's a sector which has done badly for a decade. And first it was due to non-performing loans. Recently, it has been because of low credit growth. So our view at this point of time is that at some point of time, financials has to deliver returns. The process of buying has to be maybe gradual, but eventually we think the sector will deliver returns. Mm-hmm. And we have been structurally positive on telecom for a long period of time. We have been structurally positive on power for a long period of time. That came out of a very simple view that, if you looked at COVID, the reason why we could all work was because of three things: power, telecom, and information technology. And information technology stocks actually did very, very well. So at least when they delivered, we could sell them. We had a good exposure to them, but they delivered, so we sold them. But otherwise, these two sectors did not deliver. So we said, let's sit on them because without them, we could not have operated in the post-COVID world. So we think that these are all structural sectors. In between, people thought that you can build cars without metals. And we felt that you need, for making consumer durables and cars, you need metals. So we had a good exposure to metals. Metals also delivered, so we trimmed metals. But then that call, so as such, if you look at it, quality at any price was a strategy which had become too popular for its own existence. Yeah. So we felt that was something which was due for a cyclical downturn. And that kind of benefited us in the recent past. And we think that derating is done to an extent, may not be fully, but at least it is done to an extent. And that is the way we've been thinking. But the biggest area where I feel that, there is still more froth left is not in large caps. It is in some of the small caps and mid caps. And this is not across. A lot of mid caps and small caps have corrected, but not all the mid caps and small caps. Some of the mid cap and small caps trade at valuations today which are higher than large caps. And that's why we think that there is a good opportunity in mid and small caps to be booking profits in some of the cases. And that's the way we are looking at it at this point of time.
Sure, fair enough. And just looking ahead a bit, I mean, you spoke of obviously small and mid caps towards the end, and how we're looking at sectors. But given all this, push from the government for capex and large capex spending that's happening, do you think investors should be positioned in a certain way to be able to capitalize on this kind of a theme, or for instance, do you think infrastructure funds or those kind of thematic kind of strategies or funds make sense for a 5 to 7 year kind of horizon, or would you prefer to stay sort of diversified at a point?
What we came across as a company was that we said that let's create something called thematic advantage fund of fund, and we ourselves do the job of allocation from one theme to another. Because having been the infrastructure fund manager, when I was reporting to Nilesh, at that point of time, what we realized was we got money at the wrong time. And, we used to find it so difficult to get the money at the right time. So we said, let's create one fund called Thematic Advantage Fund of Fund, where we collect money and then we invest in the themes which we think has upside. So that is how we came to that conclusion. And we have been trying to do that. Right now, we are reasonably constructive on infrastructure. But the challenge is, with oil going up substantially, it is an economic sensitive sector. Unlike pharma or consumer or information technology. So while we like the sector structurally, the tactical headwind due to oil at $120 and all the problems of Ukraine, Russia, just like Nilesh pointed out, if tomorrow someone told me that the war is over, infrastructure would be the biggest beneficiary, if you ask me, with the falling oil. So that's the challenge at this point of time, that there are a lot of geopolitical issues also which we have to think about.
Absolutely. And just on that point, Nilesh, you've spoken recently about that there is a possibility that the commodity cycle, what we are seeing right now, commodity prices obviously having moved up over the last couple of years for the reasons that Naren also just mentioned. But you've also been saying that due to central bank action, central banks obviously tightening monetary policy and so on and so forth, commodity prices could come down. So do you think that this commodity super cycle that a lot of people have been talking about actually could be short-lived rather than being extended in that sense?
So, Dhaval, it is always difficult to predict commodity cycle. They have a nasty way of surprising when you try to predict something. And clearly in Jan 22, we did an analysis that between 2019 to 2022, food, metal, and crude basket took away or contributed to 55% in incremental GDP between 2019 to 2022. They were at about 8% of global GDP in 2019, ended up becoming about 12% of global GDP because of this explosive growth. Now, can this three basket continue to consume 55% of global GDP? Answer was clearly no. A demand destruction was inevitable. And we have seen crude, bearing crude, most of the commodity prices declining, including agriculture. Obviously, from India point of view, we wanted crude to decline, and others, if they had stayed above, would not have mattered much. We believe there will be invariably demand destruction as rates rise and liquidity gets tightened. But commodity prices will also be dependent upon supply shocks. Zero COVID policy in China has created its pressure on supply. In the oil market, cartelization by OPEC and Russia-Ukraine situation has created disruption. Globally, shipping and logistics continue to remain challenged. So subject to supply shocks, which can lift commodity prices for a while, we believe there will be cooling of commodity prices.
Okay. Fair enough. And you spoke a little bit about this earlier in terms of your view on gold as well. I mean, you've been sort of positive on gold for, I think, a couple of years now. And obviously, contrary to expectations, although inflation has moved up, gold prices haven't moved up, as much as such. So what's your view now? I mean,
so clearly in a rising US dollar interest rate environment, gold does not necessarily do well. Whereas rising inflationary environment, gold should do well. So probably the positive and negative are cancelling off. But our thesis on going long gold or equal weight gold is essentially driven by the behavior of central banks. Clearly, Russia had a view on Ukraine and they prepared for it by shifting about $150 billion of their reserves out of $600 billion into gold. And today, they have realized that all the money which they had parked in, dollar, yen, euro securities is frozen. And the gold is the only thing which is available for them to raise money. I believe many central banks around the world will look at diversification. Of course, their preference will remain financial securities, but they will move towards gold, especially because that's one security which can't be frozen and which will be globally acceptable. The second, and this is more wishful thinking, that as interest rates rise globally and liquidity gets tightened, the cryptos and the NFTs kind of asset classes are coming down. Maybe eventually we will see a gold-backed crypto. There are already some models which are working, but it will become more popular and that will create demand for gold. So combination of these two factors are pushing us to be positive on the gold. Undoubtedly, in India, when you invest in gold, there is always risk of import duty because we have about 10% import duty. God forbid, if tomorrow import duty comes down to zero, you will suffer 10% loss on your gold portfolio instantly. But subject to that risk, this is time to be equal weight gold.
Yeah, yeah, fair enough. And Nilesh, just extending this a bit further in terms of all the views that we've been talking about, say on equity, on gold, and so on and so forth. So how would you suggest investors today, with a horizon of say 5 years plus a long-term kind of horizon, how should they sort of structure their portfolios? How should they invest fresh money at this point of time? Should it be staggered? Should it be lump sum investment? So how would you sort of what would you advocate on that front?
So from an asset class point of view, it is still equal weight equity within that bias towards large cap. In duration, either dynamic or floater, gold equal weight. Offshore, unfortunately, now with the limit, you won't be able to move money abroad. But if you want to come lump sum, then there are funds like balance advantage fund or asset allocation fund. That's where the fund manager takes the call of dividing or allocating into different asset classes. In balance advantage fund, you can go between equity and debt. In asset allocation fund, you can go between equity, debt, gold, and probably offshore assets, as in when the limit opens up. If you want to come directly into the funds, then I will recommend please come via systematic transfer plan. This is not the market where you want to come lump sum and take the volatility. 12 installments over next 6 months period will be a good entry point from an STP point of view. And in case you are lucky and you get a good correction, then prepone your purchases. Then don't wait for 12 installments to go through over 6 months period. This will be the best strategy for an investor. But most importantly, please be prepared for volatility. No one knows where the markets will be. And if I can take in a lighter wing, and then you'll have to excuse this explanation. There was a very famous movie called Mughal-e-Azam, where King Akbar goes and tells Anarkali that Salim ki mohabbat tumhe jeene nahi degi aur hum tumhe marne nahi denge. This is the market where there are 4 Akbars. Putin, what he does in Russia, Powell, what he does on US Fed rates, oil prices, especially from India point of view, and global inflationary behavior and impact on corporate earnings. All these things are so uncertain today that the only thing we can say with assurance is that there will be volatility ahead.
Yeah, fair enough, Nilesh. I think, that makes a lot of sense. And I'm sure it's quite useful for our participants to understand in terms of how they should look at, markets at this point of time and how they should look at their portfolios. Dan, we've been talking a fair bit about market views, right? And I'm sure you'll agree with this, that, a key driver of long-term wealth creation is investor behavior, right? And essentially how investors react during such periods of volatility or downturns, or even during strong rallies as such. And you've been an advocate of staying invested in one's portfolio over even volatile periods such as the current one, versus moving to cash or staying defensive and so on and so forth. So can you talk a little bit more about this and the importance of investor behavior essentially?
Yes, of course, Dhaval. And as we saw in the last presentation with Sagni, investor behavior is everything, really. When we think about that really long-term perspective, that the decisions that you make, the biases that you suffer, the mistakes that we all make along the way are a huge determinant of our overall success. So as professional investors, of course, we focus on the different asset classes that look most attractive, the levels of risk in portfolios, what may impact portfolios ahead of us. But really, the quality of our decision making, the quality of investors' decision making is really the determinant. And so when you start on the investment journey, I think it's helpful to think about it a little bit like getting on a roller coaster at the fairground. Once you get on the roller coaster, you seldom know what's ahead of you, and that's what the excitement is. But when you go over the top of the roller coaster and start diving down, that's when it gets really uncomfortable. And as people will know, on roller coasters, you typically have these barriers that hold you in. And my view is that they're not there to stop you falling off the roller coaster. They're there to stop you jumping off the roller coaster at exactly the wrong moment, because that's incredibly dangerous. And this is true when we have periods of market volatility, that the time we want to sell investments is not when they're overpriced, when they offer poor future returns. The time when we want to sell them is when they've just fallen, when actually they offer far better returns, and they're a much better prospect. But nevertheless, because they've fallen recently, because we feel that's uncomfortable, because we are aware of the money that we appear to have lost, then that's when we want to jump off this roller coaster. That's when we want to take our assets and put them into cash. And I've seen many clients do this over my career, and pretty much every time what happens is that people may take their money out of the market at a reasonable time, but they seldom put it back into the market. And of course, by not then reinvesting, they end up ruining the chances of reaching their financial goals. And that's why it's important to stay invested, because once you take your money out, people find it very, very difficult to get back in, because at the start, you don't want to put your money back in because you're worried markets will fall further. And then as markets start rising in, people don't want to put their money in because they feel that they'll have a better opportunity further ahead. So reinvesting is really, really challenging. That's why it's important to stay invested. But of course, if you're going to stay invested, then you have to be on a roller coaster that's not too terrifying. So getting the right level of overall risk in your portfolio, that means you don't feel this overwhelming urge to jump off at the wrong time, is really important. So start with the right level of risk in your portfolio. Think about that long-term destination, not the short-term market movements, not the trading that we've been talking about, which seldom helps people invest the long-term. And make sure that you stay invested when we have these volatile periods. And I completely agree that the best way of doing that is, instead of trying to time a lump sum investment into the market, drip feed your money into the market over a long period of time. And that will reduce the amount of volatility you experience, the upsy downsiness of markets, and probably give you a better outcome. So think about that level of risk, focus on the long term, and drip your money into the market is probably the best things that I've learned about investing over the last 25 years.
Sure, great. I think those are great perspectives. And Naren, just on that point, we were talking a little bit briefly about trading, and Dan mentioned it in our earlier conversations as well. Obviously, during the lockdown, we've seen this emergence of a new breed of investors, right? I mean, in India, in other markets, in other countries as well, such as the US, typically called as a Robin Hood kind of investors, and they've been involved in sort of active trading and driving up stock prices and so on and so forth. So, what would your advice be to these kind of new age investors who just stepped into the markets and have been involved more in active trading as such?
Yeah, I've been a stockbroker between 1994 and 2004. So I had the benefit of seeing two bull markets, 94, 95 and 2000, 2001. And, rather the bear market after that. Somehow at the end of the bull market, the retail investor got more and more and more bullish. And they use derivative products. So if you ask me, one of the key lessons that I learned watching investors as a stockbroker in that 10-year period, at least if you stopped, if you didn't use derivative products and if you didn't use leverage, you are fine at least. The moment you use derivative products and you use leverage towards the end of when valuations are high, then the losses are much more significant. Then effectively it becomes somewhere a double or quit story. So my advice to any retail investor hearing us today is please do not use derivatives and please do not use leverage. These are two very dangerous words in any bull market. And many of the retail investors who have gotten after 2020 are very, very savvy on the technology side, but they are not savvy in the market side because they have not seen cycles. They have not seen 1999 to 2003 cycle. They have not seen 95 to 98 cycle. And that's why I believe that they have to be very careful in using these two things. Otherwise, I would say that, trading infrastructure and various other things have improved significantly. But trading infrastructure does not mean you won't make losses. Even in the most sophisticated market in the world, which is USA, the kind of losses investors have suffered from last year to this year is not small. Primarily because trading infrastructure doesn't guarantee profits. It only guarantees trading infrastructure. It doesn't guarantee anything beyond that. So this is the lessons that you can learn from the most sophisticated market in the world. And even the Robinhood share price is an indicator of what trading infrastructure doesn't mean anything. This is how we get things.
Absolutely. So we've got, I think that's pretty good advice and I think pretty good perspectives that you've shared, Naren. We've just got a few minutes to go before we sort of open up for questions from the audience. So a couple of quick fire sort of questions. And I'll go with you, Nilesh, first, is that, we've seen investors burn their fingers from time to time in markets, right? Whether it was small and mid caps in 2018-19, after a strong run up, or US equities in more recent times. So in your opinion, what's the most frequent mistake that investors make?
So, Dhaval, I don't agree with you. It's trader who frequently burn them.
Okay.
Investors never. A person who came in Jan 20 did have to suffer losses in March 20 on a notional basis. But if he or she stayed invested today, despite correction, he or she is still making money. So the only reason why investors end up becoming trader and traders end up becoming investors sometimes after losses is because you are not able to balance between greed and fear. When the past performance is good, you become greedy. And when the past performance is disastrous, you become fearful. Balance. Equilibrium is the key.
Absolutely. I think that's the key mantra. I think that's the common thread that we've been discussing all through along. I think that's probably something that investors have to firmly keep in mind. Dan, you've been sort of following many great investors like many of us too. Like Warren Buffett, Howard Marks, and so on and so forth. And in your view, where do these great investors derive their alpha from? I mean, what is the key sort of factor that drives their long-term sort of performance that we've seen over probably years and decades as such?
Yes, absolutely. And I think that the first thing to say about thinking about investors with great track records is there's an enormous amount of luck involved. And we could spend time looking at it from the mathematical perspective, but just bear that in mind. If ever you're looking at a portfolio manager with a long and great track record, then luck will have played a role. And so we need to sort of separate that out. But within the skill parts of investing, then there's really three sources of advantage for an investor. The first is an information advantage. So if you know something that no one else knows, then you will make money. The problem is that it's illegal. And so I'm definitely not going to recommend trying to access an informational advantage. The second is an analytical advantage. is if you can take the knowledge that everyone has, the data and information that everyone has, and analyze it better than everyone else and do that consistently, then that will convey an advantage. But what you have to remember when you try to do that is there are literally millions of people around the world all trying to do the same thing, and they're all incredibly smart, and so creating a consistent advantage through your analysis, through an analytical skill, is going to be extremely difficult. It's where we all spend most of our time trying to, at least if not create an analytical advantage, make sure we don't fall behind in terms of analysis, but nevertheless, it's very, very difficult. And then so the third advantage is behavioral. So if you can do something different, if you can think differently, if you can behave differently from the majority of investors, then that will convey a real advantage. And that's extremely difficult to do. You have to have the right temperament. You have to think about how you make decisions. You have to have the right structure around you and not fall prey to the sort of trading habits that we've just been talking about. And you have to be able to take risk when everyone else is incredibly fearful, and then not be too greedy when everyone else is very brave. And that can be an extremely difficult thing to do, particularly in some of the markets that we've seen over the last couple of years. But if you can look more rationally at a set of markets and look at where investors are really fearful or ignoring a market entirely, then you potentially can find good opportunities. Equally, moving away from the markets where people are over-optimistic and particularly enthusiastic is key as well. And if we look at people like Howard Marks and Warren Buffett, they're all people, or they're both people rather, and there's many more who've been able to behave differently consistently over several decades.
No, fair enough. I think that makes a lot of sense. And I think the common thread, again, as we've been discussing, is one is maintaining a balance in your portfolio, following asset allocation. And I think, the way you react to different scenarios like we've just been discussing in terms of your own behavior are sort of key drivers of performance or long-term sort of wealth creation, so to say. Now, just quickly moving on to sort of, questions from the audience, and there are quite a few of them. I'll just try and pick some topics or some areas that we haven't covered in our conversation today. And this first question comes from Nitish Mishra. His question is that, why are Indian startups getting such high valuations, and will, loss-making startups survive after 10, 15 years? I mean, we know these names and some of them have been listed recently. So, I mean, any of you, that would like to take up this question, sir? Naren, Nilesh, or
I haven't invested in them, so I'm not the right person to answer.
But that itself says a lot, right?
No, it's lack of my understanding and my ignorance than anything else.
Okay.
I think on behalf of Naren and me, I can say that we are well past our expiry date to invest in such companies.
Okay.
But I can tell you the other part. See, we both Nilesh and I invest on behalf of other people. So the advantage that the first few startups in this kind of field, which came for public issue of cost loss to investors, has made me very happy, because at the end of the day, the next IPOs, people will have to be more careful in deciding the issue price. Otherwise, we were very fearful that companies will say, so what if there is a loss? Give us this valuation. Now people are coming to us and saying we have to be more disciplined in valuation. So the bad experience in the first few startups which have gone public has made it much beneficial for people like us who are managing other people's money. So that's a positive I can tell you. On this question, I can only tell you, when Google started, I used to think who's paying for Google. And I used to think, how can Google survive? Who's paying for it? But suddenly later I realized that the advertisers are paying for it and they monopolize the advertiser market. And I never knew that when I was using Google. So sometimes what happens is we are not capable of thinking the revenue streams of some of the companies. And in some of the companies, we are not capable of guessing that they'll go bankrupt. Both are true.
Sure. Fair enough. So effectively, you're saying that there could be potential blind spots that we might not be aware of, but again, uh, are you saying that it's very difficult to assess how these would go over the next 10, 15 years, or?
I'm saying luckily the Indian listing of startups are going to be made care after the failure of the listings of some of the first few startups. That's all I'll say, nothing more.
Sure, fair enough. Another topic that's been obviously something that's been discussed more in recent times. Obviously, it's been around for quite some time. Is ESG, right? And another question that's come from the audience is that is ESG investing a fad, or does it have staying power? So, Dan, would you like to take it up, or?
Yeah, happy to. And so for context, I manage some of Morningstar's ESG portfolios. So I'm not without bias in this area, and you should be aware of that. But I think there's a couple of aspects to ESG. One is looking at the ESG risk of companies. And this was ignored for a long time. But as we've seen tightening legislation, as we've seen consumer taste change, as we've seen everyone around the world trying to grapple with the challenges of climate change, then ESG risk is far more prominent. And currently people try to address their ESG risk, often by investing in ESG funds. In reality, I think addressing the ESG risk of investments will be part of all of our processes going forward. And that's just simply part of the investment process, like we do financial analysis now. If people aren't doing an analysis of ESG risk in their portfolio right now, they certainly will be in the future. So I don't think that will be a separate style of investing. It will simply be part of the core work we all do. That's very different from people expressing their values and their preferences through their portfolios. So some people won't want to invest in tobacco companies or arms companies or even mining companies in some cases. And so in those circumstances, it's really all about personalization. It's all about trying to access a portfolio that's aligned to your values. Now, in the past, that's typically meant either having to do your own research or build your own portfolio, unless you're extremely wealthy and have someone that could build an individual portfolio for you, or it would mean buying a fund that has a selection of exclusions and a selection of emphasis on more positive companies. What we're now getting to is a stage where, because of the incredible enablement of trading infrastructure, portfolio infrastructure, as was mentioned earlier, then you have a chance for more people to build personalized portfolios. And so my guess is that over the next few years, the focus won't be on ESG products. It will be on how you build a personalized portfolio which has the ESG characteristics that you want. Now, that's into the future in many markets, but I think that's what we'll see. So I don't think it's a fad. It's just a different way of investing.
No, fair enough. I think that's all we have sort of time for today. Thanks a lot, Nilesh, Naren, and Dan Kemp. It's been wonderful hosting you, and thanks for sharing your views. They're always insightful, and I'm sure they're very useful for our participants as well. So thank you very much, and have a good weekend. Thank you.